Good morning. This is Kenny Rush, the host of the How to Raise $1 Million in 90 Days. And today, I have the privilege of bringing on to the makeshift stage right here my good friend, who actually was the first guy who gave me a hard money loan almost 8 years ago. And in fact, he's going to share with you, I'm sure, that story of how that took place. You guys need to realize that hard money is a good way of funding your real estate deals. However, you need to make sure that you use hard money the right way. I've seen a lot of guys almost go out of business because they had too many hard money loans. And because they could not pay those monthly payments on 6 or 7 hard money loans, their properties probably went back to the hard money lender, or they went out of business pretty much. So hard money is a good way of being able to fund your real estate deals. Hard money, you're normally going to pay 5 points, 15% interest, or 3 points, 12% interest. It just depends on the hard money lending company that you work with. But this gentleman who I'm going to bring up has been involved in more hard money deals than I know of. Over 1,600 hard money loans, over $100 million in loans in the last 10 years. So he is an expert at hard money lending. He's also a real estate investor as well. He's been involved in over 100 projects himself. So not only can he give you advice as far as how to obtain hard money, but he can also share with you advice on how to be a sophisticated real estate investor. So with that said, I want to bring my good friend up to the makeshift stage, Mr. Richard Wells.
Wow. Thank you. What an introduction. Expert, that's what he called me. You know what an expert is? X is a has-been and a spurt is just a big drip under pressure. So that's me, expert. Before I get started, let me tell you just a little bit, if I may, about myself. Vice President of Sales with Kenny Rushing, and after the hard money debacle economy in 2007, I had a couple of physical problems as far as knee replacement surgeries and so forth. And then Kenny gave me a call and asked me what I was doing. I said I'm recuperating, and I ended up coming to work, working primarily in bulk REOs and NPNs, mostly on the commercial side. But prior to that time, I was a loan officer for a company called Lending One, who was a hard equity specialist. And as he said, I did a little over 1,586 loans. It wasn't quite 1,600 in a period of about 4.5 years. I told everybody at the home office it was because of my hard work and my intelligence that I did that. The fact that it was in Tampa, which was the second or third highest, busiest real estate market in that time, might have had something to do with it. So the situation was such as I'm just like everybody else. I went to high school, I graduated, I went in the Marine Corps, got out of the Marine Corps, went to work for a mortgage and loan bank as a loan servicer. I didn't even know what that was. Loan servicer is a guy that knocks on the doors for house payments. So that was a good experience. Got out of that real quick, went into the insurance business, 28 years. Got out of that business, hard equity lender for 16 years altogether. So my dad was a contractor. I've also built houses, and as an inspector for hard money, I also had to go out and approve the draws for the repairs that were completed. So I have some experience in there, and I also am a real estate investor. So I don't know if that qualifies me to be up here to talk, but at least it's a situation that I think I've got enough experience to talk about hard money. The one thing I'd like to say, this is an open forum. You can ask questions if you wish. However, having done a couple of these in my life, I think if you'll save your questions to the end, I can answer about 95% of them as we go along, because I can sometimes guess what they are. Okay, first question is, what is hard money? What's versus easy money? Anybody know? The term hard money started out, and it's also called hard equity loans. They're also called A&I loans, acquisition and improvement loans. Okay, they first started out in the 50s, 60s, and 70s by They were all, first of all, private investors. There was no banks involved. It was almost like it was on the streets of New York charging VIG, if you know what that is. They were very high priced. Back in those days, they would loan you 40 to 50% loan to value. The reason that it was so expensive and the LTV was so low was to protect, that person that's giving you the loan, to make sure that they can't lose any money. And back in the old days, because it was all private money, they would make you that loan 40 to 50% loan to value and then hope that you didn't make the payments. And they would come in and repo that property and they would get something for 50 cents on the dollar. Well, as time went on, 80s, 90s, 2000s, it became a situation that there were a couple of banks that actually started doing this type of lending as well. But the biggest advantage to hard money is the fact that they could care less what your credit was. Okay?